All right, let's dive into Aramark's latest earnings report for fiscal year 2025. You listen to the company, and they're talking about a year of massive achievements. But then you look at the stock, and it tells a completely different story. So what's going on here? We're going to get into the numbers and figure out what's behind this huge disconnect. And really, this is the core puzzle we're trying to solve today. You've got the CEO, John Zillmer, calling it a year of consequential milestones. I mean, he's pointing to all these record-breaking numbers. But even with all that positive talk, the stock just got hammered right after the announcement. So the question is, what on earth did investors see that maybe management was overlooking? I mean, look at this. It lays out the conflict perfectly. On one hand, you have the company's story, right? Record new business wins, their balance sheet is the strongest it's been in 20 years. But then you look at the other side. The stock drops anywhere from 5 to 8%, and it's on 4 times the normal trading volume. Wow, that is a massive disagreement between the company and the market. Okay, so let's start digging in. We're going to look at the hard numbers, the Q4 report card, and see exactly how they did against what Wall Street was expecting. And boom, here's the first big piece of the puzzle. It was a miss. And not just on one thing, it was a miss on both the top and bottom lines. Revenue came in at about $5.05 billion. That's roughly 2% below what everyone was thinking. But the real ouch was the adjusted earnings per share, 57 cents. That's a full 11% below what was expected. That right there is enough to put any company on its back foot with investors. So the big question is, why? How can a company be crushing these huge long-term goals, but at the same time completely miss their short-term targets? It's like two different stories. We've got to unpack both sides of this thing. So let's start with management side of the story. The CEO's quote here really frames up the bull case. The argument that says, hey, the underlying business has never been stronger, and our long-term plan, it's working perfectly. And look, the numbers here are pretty impressive. You can't deny it. We're talking a record $1.6 billion in new business wins. That's up 12%. They've got the best client retention rate in the company's entire history. On top of that, you've got strong net new business, a 20-year low on their debt, and they're raising the dividend by 14%. I mean, on paper, that paints a picture of a really healthy growing company. Okay, so if the full year story is so rosy, it just brings us right back to that question. What in the world went wrong in just this one quarter, Q4, to cause such a big miss and totally spook the market? Okay, so here's the bear case, the reasons for the miss. It really boils down to 3 things. First, you could say their success actually cost them. They had to pay out about $25 million in bonuses for landing all that new business. That's a good problem to have, I guess, but it hits the bottom line, about 7 cents per share. Second, timing. Some really big new contracts in healthcare and corrections just didn't start when they were supposed to, so that revenue gets pushed into next year. And finally, just a bit of bad luck, honestly. Most of their MLB teams didn't make the playoffs, so that stadium revenue just wasn't there. All right, so that was Q4. But as you know, what investors really care about is the future. So let's look at management's guidance for the next fiscal year, 26, because a lot of the time, that outlook is way more important than what just happened. And here's where the other shoe drops. This is the second big reason the stock got hit. The revenue guidance for next year, it was fine, pretty solid actually, right in line with what Wall Street was looking for. But the earnings guidance, not so much. They're guiding to somewhere between $2.18 and $2.28 per share. And the consensus? It was just a penny higher at $2.29. But when you've already missed the quarter, even a slightly cautious guide for the year ahead, well, that's just a really tough combo for investors to swallow. Okay, so let's put it all together and figure out what our call is. We've got this picture of really strong fundamentals, all these new wins, but it's being clouded by these short-term stumbles and a kind of conservative outlook. So what's our thesis? What's our rating going to be? So here's our take. The long-term story is still very much intact, right? It's fueled by those record contract wins, and that's super compelling. But right now, it's just being overshadowed by these near-term execution fumbles and timing delays. So the key catalyst, the thing we are all going to be watching for, is simple: execution. Can they cleanly onboard this massive backlog of new business? We're talking especially about that huge Penn Medicine contract. They have to prove they can turn these wins into consistent, reliable earnings. Until they do that, it feels like a pretty balanced risk versus reward. And for that reason, we're slapping a market perform rating on Aramark. Look, we think the stock is probably going to trade right alongside the broader market for a while. That is, until we see some clear proof that these recent execution hiccups are in the rearview mirror and that the real earnings power from all these new contracts is finally hitting the bottom line. And of course, just a quick reminder for everyone, this is not financial advice. Everything we've talked about today is for informational purposes only, so please make sure you do your own homework.